Good evening.
Good evening.
Good evening, everyone.
Good evening, all.
Good evening.
How's everybody liking the cool weather?
Love it. Love it.
Loving it, loving it.
Great.
That's okay.
All right, let's get started. All right. So I want to start with let me just start with some announcements. So let me just get some announcements out of the way. Okay, so next week, next class, November the 26th will be our last teaching session. Okay, and we will hopefully cover chapters 11 and 18. So you can read up those two chapters in preparation for next week's class, chapters 11 and 18. And next class will also be your last homework assignment. You will have a homework assignment again tonight. So you have two more homework assignments, one tonight and then one next week. And then our last class is December the 3rd, which will be a review class or revision class. So if you have any questions, you can, or anything you want to go over in particular, you can bring them up that evening. I'll be doing a review. Our last class, so that'll be December the 3rd. And also there'll be some final instructions before the final exam, and giving you some exam tips. If I'm not mistaken, I'll have to confirm it. I think you have a week before your final exam. So that would mean your exam is on December the 17th. Okay, I will confirm that tomorrow. I was unable to confirm it today. Okay, but normally you're given a week off after the last class and then the exam. Okay. So any questions?
Will the
Hi,
test
Mr.
be
Did you ever
in
send the results
person?
from the first midterm?
Okay, I was getting two questions.
Oh, I'm sorry. Did you ever send the results from the first midterm?
Yes, I sent those this morning.
Oh, okay.
Along with the homeworks 4 and 5.
Okay, thank you.
4 and 5 and the midterm. And you were to collect, starting Monday past, you were to collect your scripts from the institute so we could go over the
Okay.
interim.
Yeah.
Okay. All right. Someone else had a question, sorry.
Night, I was asking if the test would be in person or would it be take online?
It'll be in person, just like the interim exam, the midterm exam.
Okay.
Okay, and the format will be the same, similar. Okay.
Okay.
So having said that, let me just do some reminders. Okay. Course overview reminders. Homework assignments, they're basically true, false, multiple choice, fill in the blank. Midterm, we already did that. The final exam will be the same. Plus one in-class case study type question, similar to what you did on the midterm or the interim exam. Okay. We'll have a minimum of 10 chapters, probably 11, and one from module 2. Because I don't want to give any new information and teach anything new on the last night of class. Okay, I want to leave that exclusively for just review. So it looks like you'll probably get 11 chapters in module 1 and 1 chapter in module 2. Okay, and that one in module 2, as I said earlier, is chapter 18. So you start reading that. Okay. And again, this reminder, your success, attend classes, ask questions, participate in class discussions, activities, do your pre-reading and rereading, complete end of chapter questions, submit homework assignments, well, ready to the interim exam and sit the final exam. Okay. The grading, just as a reminder, is as follows. Excuse me. Homeworks represent 20% of the grade. Midterm represents 30%, and the final exam represents 50%. Okay. So, any questions before we go on further?
No, sir.
Okay. All right. So, what we want to hopefully achieve is we'll go over the interim exam. We'll look at typical exam case study question, the James and Paula Brown case, which was on the midterm exam and was also on homework number 3. That's the homework I did not grade. I did not take a grade. Some people attempted it, some didn't. But James and Paula Brown, you would have come across that twice, like I said, once in, as a homework assignment and then once on the midterm exam. And then we'll continue with documentation, structuring documentation tonight, types of legal documents used, the storage of the documentation, and also monitoring and controlling reports. Okay, the different type of reports that you use for monitoring and controlling. Okay, so let's begin by looking at section 1. So if you would pull out your exam scripts. Now there were several questions, excuse me. There were several questions that I identified that we had not gone over at the time. And so those persons who would have gotten those questions incorrect, I went and I gave you credit for those questions. Okay, so no one should be adversely impacted. I think there were at least 3 questions that we had not covered as yet. Okay. Okay, so question 1, and I'll just go over the answers. There were some questions that were, I did a review of the answers to the questions. There were some questions that were not as well done by 40 or more percent. So those questions I will actually read and go over and point out where the answers are. Okay. So in some cases, we have 40%. That is 4 or more of you got them incorrect. So in some cases, I think in one case there was as many as 7 persons who had gotten an answer incorrect, or 6. Yeah, there was one that was actually one that actually eight of you got incorrect. And well, yeah, well, actually, that's a question. I'm looking at, yes, that's one of those questions that so there are some questions where 4 or 5, the ones that were higher than 4 or 5 of you getting them wrong, 50% of you getting them wrong. Those were not questions. So the ones that were higher than 5, those were the questions that those were the questions that we hadn't covered yet. So okay, so it's not as bad as I initially thought. But I'm going to point you to the answers for all those where 4 or more persons got them incorrect, which would include the 3 or so questions that we hadn't covered. So let's go. So question 1 in the true or false is A, true. Question 2 is false, or B. The answer is B.
Oh, sorry, Mr. Knowledge.
3.
I am so sorry, Mr. Knowledge.
Yes, ma'am.
I am so sorry. I thought you was going to show the slide. Please forgive me.
Oh, that'd be too many slides for me to show. That was too many slides to
Yes, sir. You don't even have to say 1, 2, and 3. Just tell me A, B, C, or whatever, and I'll go down and put it in.
Okay. All right. So 1 is A. I'll start again. So 1 is A. 2 is B. 3 is B. 4 is A. 5 is A. And the answer to that is on page 30. That's where it says your total debt service ratio, or total debt, your TDSR, or total debt service ratio, is the percentage of your monthly income that is used to pay your loans and other monthly fixed commitments. Okay, 4 persons got that incorrect. So that's 5 is A, and on page 30. Okay. 6 is B.
It's an audit. Sorry, you're not sending these answers.
Pardon?
You're not sending these answers. Are we to write it down? Is my question before we start writing, or are you sending them?
Well, you should go according to your scripts, because remember I told you to collect your scripts from the institute. So from
my
Monday
apologies.
up until today, you didn't get, okay, alrighty.
Can you go back over
sure.
1, please? Can you start over, because yeah.
Okay, so for anyone who doesn't have their script, pull out a piece of paper and write these answers down. Do 1A and whatever it is. Okay. If you don't have your script, Like I said, I will, those where 4 or more people got the answer incorrect, I will actually read those questions and tell you what page the answer is on in the text. Okay? So everyone has a sheet of paper that they can put the answers on
Yes.
now?
Yes.
Okay. All right, good. Yeah, see, midterm and final exams, we don't send we don't send the answers out like I do with the homeworks. Okay? That's standard practice in education. All right. Okay, so I'll begin again. Okay, so 1 is A, 2 is B, 3 is B, 4 is A, 5 is A, and the answer is on page 30. 6 is B. The answer to that is on page 33. So 6 is B. The answer is on page 33. 7 is B. The answer to that is on page 32. Okay. The operative word there was balance. You don't do your DSRs based on the balance. You do it on the credit card limit. Okay, so you have to watch out for words. Okay, those are some of the kind of tips that I will give you in the last class when we go and doing the review. So 7 is B. The answer is on page 32. 8 is A.
Excuse me, Mr. Nottage.
Yes.
Hi, yes. For question number 7, what page you say that the answer for that is on?
Page 32.
32? Okay.
You said, Mr. Nottage, these are the answers for the midterm or the homework?
It's the midterm.
Okay, so
But we don't have the
You
questions.
said B or A?
For which question?
number 7, that's what y'all talking about?
Yes, 7 is B.
So what's the correct answer for that, Mr. Nottage, for number 7?
B?
B. B.
No, I know it's B,
7
but
is
I
B.
mean in the actual answer for the question.
Oh, okay, it should be limit, not balance. So it says, with respect to DSRs, debt service ratios.
Okay.
Okay?
Understood.
Yeah. If you don't have if you haven't collected your script, at the institute, you need to collect it, and that way you'll see the questions and how the answers relate. Okay. So for the
I'm
for the
sorry,
night,
is
for the
this
night,
common knowledge? Yeah, I don't understand what's going on here.
Sorry, what you mean? What common knowledge?
But collecting the script from the school. I mean, I didn't know that's what would happen. So I don't have mine. I was waiting actually to figure out what was going on, why we didn't get them back as yet.
He mentioned it last class that we had.
Yeah, he mentioned it last class.
I said it in class, and I sent out an email.
No, I got the results. I got my result.
Hold on.
But I'll go back. I'll go get it. Okay, now I know.
I said it in class. Listen to me, please.
I'm listening.
This is taking longer than it ought to take. I said it at last class, and I sent out an email saying to begin to collect it.
Yes,
okay.
Yes,
Continue.
I saw it.
So if you don't have your script, just put down the number and the corresponding letter. And
Okay.
for now.
Okay. Okay, Mr. Norwich.
Okay. So let me go back to 7. 7 is B. And the answer for that is on page 32.
Okay.
Alrighty. 8 is A. 8 is A. 9 is A. 9 is A. 10 is A. 10 is A. 11 is B. 11 is B. 12 is A. 12 is A. The answer for that is on page 11. 13 is B. 13 is B. 14 is A. 14 is A. 15 is A. 15 is A. 16 is B. 16 is B. 17 is B. 17 is B. 18 is B. 18 is B. 19 is A. 19 is A. 20 is B. 20 is B. 21 is A. 21 is A. 22 is A. 22 is A. Excuse me. 23 is B. 23 is B. 24 is A. 24 is A. Okay. Let's go on to section 2. Section 2, question 1. 1 is F, as in frog. 1 is F, as in frog. 2 is D, as in dog. 2 is D, as in dog. 3 is E, as in elephant. 3 is E, as in elephant. 4 is F, as in frog. 4 is F, as in frog. 5 is E, as in elephant. 5 is E, as in elephant. 6 is B. 6 is B, as in boy. B, as in boy, for number 6. And that would have been one of those questions that we hadn't covered yet. So that's on page 38.
Sorry, which number is that?
That was question 6.
Question 6.
6
Okay.
is B. So that's on page 38. And also question number 7 is one that we hadn't covered at that time yet. So 7 is A, as an apple. 7 is A, as an apple.
So, Mr. Naj, I have a question. If we got that wrong, will we still marked? So will points still taken off for that?
No, I gave credit. I went back and I gave credit.
Okay.
So when you see your scripts,
Mm-hmm.
you'll see an initial figure, and then you'll see a mark through,
Mm-hmm.
and then I adjusted it.
Okay, I see that. Okay, thank you.
Now, if you come across, because there were at least 3, I think. There were at least 3, but if you come across any others, shoot me an email when you get your scripts, and I will look at it. Okay.
Okay.
Right.
So if we got it correct, did we get extra?
No.
Oh, wah, wah.
It's just those who got it wrong would have. If you got it wrong, you weren't penalized.
Alrighty.
I tried to think of the most equitable way to deal with it. So I just gave that. It was easier to give the answer back than to, start, instead of marking it out of 50, to mark out some out of 49, some out of 48, whatever it is. The easiest thing was to give the credit back.
Alrighty.
So let me just say 6 is B, as in boy, page 38. 7 is A, as in apple, and that answer is also on page 38.
Okay.
All right.
Thank you.
Question 8. You're welcome. Question 8 is D, as in dog. D, as in dog, for question 8. 9 is B, as in boy. 9 is B, as in boy. 10 is D, as in dog. 10 is D, as in dog. 11, excuse me. 11 is one of those questions as well. Okay, so 11 is B. 11 is B, as in boy. And the answer is on pages 37 and 38. So again, 11 is B as in boy. Pages 37 and 38 is where the answer is. 12 is C as in cat. 12 is C as in cat. 13 is A as in apple. 13 is A as in apple. The answer for that is on page 30. Page 30. 14 is F as in frog. 14 is F as in frog. The answer for that is on pages 29 and 30. So pages 29 and 30. 15 is D as in dog. 15 is D as in dog. The answer for that one is on page 32. So page 32.
That's number 15?
Number 15, page 32.
Okay.
Then, then question 16. Question 16 is A as in apple. A as in apple. "17 is E as in elephant. 17 is E as in elephant. And the answer to that one is on page 17 and 18. Pages 17 and 18 for question 17, section 2. Question 18 is A, apple, as an apple. 18 is A as an apple. The answer to that one is on page 17. Page 17. Question 19 is E as an elephant. E as in elephant for question 19. 20 is C as in cat. 20 is C as in cat. The answer for that is on pages 30 and 31. Pages 30 and 31.
Sorry, Mr. Nottage, I didn't get the answer for number 20.
20 is C as in cat.
Thank you.
Okay. Now let's move on to section 3. Fill in the blank. Question 1. You may either have sole proprietor or sole trader. Okay, so sole proprietor or sole trader is the answer for question 1. Question 2 is borrowing resolution. A borrowing resolution is required because a company, etc. So the answer for question 2 is borrowing resolution. Question 3, which asks you to list 2 features or benefits of mortgages. So I'm going to give you 3 options. You were to select any 2. So the first one is longer repayment terms. Longer repayment terms. The second one is lower interest rate. Lower interest rate. And the third one that you could have chosen would be accumulate equity over time. So accumulate equity over time. So I'll go over those 3 again. For question number 3, you can list any 2 of the following: longer repayment term, lower interest rate, or accumulate equity over time. Four, the answer is mortgage, M-O-R-T-G-A-G-E, mortgage. 5 is the decision. The decision. Okay, the bank's response is comprised of the following: the assessment and the decision. So the blank that you needed to fill in was the decision. That's on page 27. Page 27. 6. Excuse me. 6, the blank is during. The question was, blank the interview, the following techniques should occur. So during the interview, the following techniques should occur. 6 is during. 7, asks to list 2 sources of credit history. And so you could have put any of these. The first one was given, which was utility bills. So apart from utility bills, you would put either existing loans, credit cards, or some people put credit card statements. Same difference. So existing loans, credit cards or credit card statements. Life insurance policies. Life insurance policies. Savings accounts. Savings accounts. College fees or college fee payments. And then the last one was equity built up in property. Equity built up in property. Okay, so I'll go over those again. Existing loans, credit cards, life insurance policies, savings accounts, college fees, or equity built up in property. then question 8. The blank to fill in was underwriting. 8 is underwriting. UNDERWRITING. Okay. Now, given that a number of you don't have your scripts, I won't go through the case study type question. I will do that next class. Hopefully, everyone will have their, because it's difficult to go through that without you having your scripts. Okay. Because I wanted to do also with James and Paula Brown, I wanted to do what we did with the last class with the roles, Martin and Sherry role, with regards to the three key factors of character, ability, and insurance in terms of justifying your answer, whether or not you would approve the loan or not. So we'll do that next week. Hopefully you'll all have your scripts, and we'll go through we'll go through the net worth statement and the TDSR calculation chart. Okay. In any event, you should have access to that, because we that was one we looked at in class after the homework, for the homework assignment. So if you look back at that, you'll be able to see the answers from that. And again, we'll go over it next class, because it's really difficult to go through it. Okay. So please collect your scripts from the Institute. Okay. For some of you, there'll also be the physically graded homeworks 1 and 2 that I had printed. So they would be attached as well. So most of you will have 3 or so scripts attached to your package. Okay. So now with regard to the midterm exam, everyone passed. Okay, everyone passed. The average grade was 88.6 or 89%. Okay, so the average grade was 89%, just under 89%. So that was good. Okay, so please continue to to begin your review now. Don't wait until that last week. Like I said, review your the end of chapter questions, your homeworks, the midterm. Okay, and you should continue to do well. Okay. Now, some of you haven't. Well, the last set of homework, I think only 6 persons sent in the homework. So you can pick up some easy points by submitting your homework assignments, because that's worth 20%. Okay. So if you didn't get to submit this one for whatever reason, don't freak out, because I normally throw out the lowest grade. So if we've done 5 homeworks, I'll throw the lowest grade, so it'll be based on the other 4. but I think we're on target to do about 6 homeworks, because I'm going to give you another homework tonight. And like I said, there'll be another homework assignment next week. Because I find that the homework assignments kind of help to point you into what you need to look at in terms for your final exams and or the midterm, which is already passed. Okay, so so like I said, we'll probably end up with like 6. Let's see, it's 4, 5, 6, probably like six homeworks. So if you've missed one, like I said, that 0 will count as the one that I throw, the lowest grade that I throw out. Okay. So, and everyone gets that opportunity. So if you are used to scoring in the high 90s or the 90s or the high 80s, and you got one low grade, that low grade, will be thrown out, and the remaining higher grades will. Okay, so everyone will benefit from that. Okay. Any questions before I move on?
Mr. Knowledge,
Yes, go ahead.
will we be having a mock interim final exam like the way you did the midterm exam?
What I will probably do is I will go over some questions in the last class.
Mm-hmm.
I don't know if you were here when at the beginning, but the last class I tried to reserve just for review.
Okay.
And so what I will do is I will go over some questions in that last class, and I will at the end of the class, as with all the presentations, you'll get a copy of it with the correct answers.
Okay.
So that'll kind of act like a kind of mock.
Okay. Thank you.
Okay. All right. Any other questions before we go into tonight's lesson? Well, let me just advance this, because we're not going to do that. Go to the next week. Okay, then no further questions, at least right now. Let's move on to chapter 9. But before I do, what I want to say about chapter 8, just to reiterate that don't be concerned about page 50 and 51. Okay, that's the last 2 pages of chapter 8. Okay, and likewise the corresponding questions. So that was question 4.
Sorry, Mr. Knowledge,
Mr.
we're getting a
Knowledge,
lot
we're
of
getting
static from your
feedback.
end.
Pardon?
Feedback and static.
Sorry, I didn't get that. Sorry, go ahead.
We were getting feedback and static from your end.
Oh, okay. Well, I can't expect that because the weather. So let me just go back. Like I said, before I go to chapter 9, let me just I just want to make it clear with regard to chapter 8. Chapter 8, we did not cover page 50. Nor page 51. Okay. The only thing we did on page 50 was talk about the VAT on amounts 100,000 and below, 100,000 and above. But that chart on page 50, we did not cover that. So, and neither did we cover page 51. The two questions that relate to that are the end of chapter or review questions is questions 4 and 6. Okay. Questions 4 and 6. So when you're doing the end of chapter review questions, for chapter 8, ignore questions 4 and 6. Okay. Everyone heard that?
Yes.
Okay, great. Okay, so okay, so let's look at chapter 9. Chapter 9 begins page 53. Okay. Chapter 9 begins page 53. So what we'll be covering is basically 3 areas in this chapter, the various documents used, some of the basic, the more common documents, and you'll see them listed there, the promissory note, the bench, etc. We'll be looking at the storage, management, and control of documents. In particular, the files, excuse me, the customer files, the credit files, and the security files. We'll talk about that. And then we'll look at some monitoring and control accounts, or I should say really reports, monitoring and control reports. Okay, so let's begin with the different types of documents used. And like I said, we're beginning on page 53. Okay. So promissory note. It says here, this document is an unconditional promise in writing to pay on demand or at a later definite time a sum of money. It is usually used when granting a personal loan. That is, the person is purchasing an automobile, furniture, education expenses, etc. Okay, so it's normally used for a personal loan. And again, some of you, your financial institution may say consumer loan. So personal loan, consumer loan, same thing. Okay. So sometimes some organizations, even when they're doing mortgages, they will ask that a promissory note be executed. So it's strange. I think one or two of the Canadian banks ask for, in addition to the mortgage document, they want a promissory note. Okay, but normally you'll get you'll issue a promissory note. The customer will execute a promissory note for a personal loan or a consumer loan, and that is the primary document of proof of debt. Okay, so basically the wording says, I so and so, or if it's more than one person, we so and so and so and so hereby promise to pay, and then it'll say list the name of the bank, the sum of, and it's normally the dollar value is in numbers as well as in words, and then it'll state the interest rate for a period of or how many payments. So if it's over a 5-year period, let's say 60 equal installments, blah, 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 blah. So basically the promissory note just outlines, basic, generally speaking, what the loan is all about, okay, in terms of dollar value, interest rate, and term. Now, there was a time when the promissory notes I remember in my time at Barclays Bank, we used a check. So so any unused checks, we used we let the customer sign them, because on the check it has the date to the top, it has a payee, okay, and it has the line for you to put in words, the amount, and it also has a line, a space for you to put the dollar equivalent, and it has that line at the bottom for the person to sign. Okay, so in the early days, a promissory note was pretty much banks used checks, unused checks for promissory notes, because a check is a type of promissory note. Okay, and what would happen is we would also have, once the client received the funds, or about to receive the funds, they will endorse it on the back, so they'll sign it on the back of the check. So it's similar to cashing a check in the bank. You would ask the person named on the front, payee Glenn Nordich. So you'll ask Glenn Nordich to sign on to sign on the back, okay, as evidence of having received the funds. So that was how a promissory note initially was in many banks, decades ago. However, it has evolved where it is a lot of promissory notes are on a regular letter size sheet, and it's a little bit more detailed nowadays. Okay, so if you have not had an opportunity to see one, you can probably visit your loan department or your credit department, and ask someone to see what a blank promissory note looks like. Okay, and then you could read it and see those different details. Okay, so that's a promissory note. Okay, and again, that is the primary evidence of debt. Then there's the debenture. Okay, the debenture is another type of charge document. Okay, and it says that this collateral can only be offered by incorporated companies or limited companies. It creates a charge over the fixed assets of a company or the floating assets of a company. And in some instances, it can create a charge over both the fixed and floating assets of a company. I'll get back to fixed and floating assets in a minute. It says it captures the assets of the company now and in the future, whatsoever and whosoever. This document is normally prepared by lawyers or attorneys. Okay, so going back to fixed assets and floating assets. So the fixed assets of a company would be like building, equipment, machinery. If it's, let's say, the dry goods store, it'll be the display cases and the shelving and whatnot. Okay, those are air conditioning units, whether it's ductless or whether central air conditioning, whatever. So those will be fixed assets. Floating assets normally tend to refer to stock in trade. Okay, so inventory. So again, if it was a dress store, department store, it would be the clothing in the store, the hair accessories, or whatever that store was selling. So their inventory, and it's floating because inventory comes in and goes out. New inventory comes in and out. The same thing would be, okay, let's take, for example, H. Pritchard. The inventory would be whatever products they sell to the other individuals and or other stores. Okay, and so the inventory changes from moment to moment. So that's why it's called floating assets. So on a business, you take it over to fixed. and the floating assets, or you can take it on either one or the other. Okay, and that's the debenture. And that is why you have the phrase underneath it that says it captures the assets of the company now and in the future. Okay, and whatsoever, meaning the items, and whosoever, it means whoever's in charge. Okay, so even if the ownership changes, while this debenture is still active, that means any credit facility that it covers. So whoever takes over the company, they are on the hook under that debenture. Okay, so it captures now and in the future. That is the assets that you have now or any future assets, and whatever those assets are, and whoever owns those assets at the time. Okay. Any questions on that before I move on to mortgage and chattel mortgage that I mentioned previously? Okay, so let's move on to the other the other four. So we start with mortgage. Okay, so so we use the word mortgage, but oftentimes you may have people saying a legal mortgage or first demand legal mortgage. Okay, but it's all the same. It's just terminology. Some people want to be a little bit more specific, particularly lawyers want to be more specific. So legal mortgage or first demand legal mortgage, because there is something called a second mortgage, okay, where you take a second mortgage over the same item. Usually it's real estate, okay. So this document creates a charge over specific real estate. Some mortgages serve as all monies or continuing collateral, which by nature allows the borrower to reborrow against the same security document. So, so if you have anyone talking about there's an all monies clause in the mortgage document, basically it's kind of like a revolving credit type document. Okay, so they can use that particular mortgage document against any new lending, and if it's a if the mortgage actually specifies a time frame, once that loan is paid off in that same time frame, the person can, as they say, reborrow or borrow again. Okay, as long as the time frame is observed. Now, if you have to go outside that time frame, then you have to do you have to do an amendment to the legal mortgage, and that document is called a variation of mortgage agreement. Okay, we're not going to get into that, but I'm just mentioning it to you because you may come across it. Someone may mention it. Okay, so if you are varying the terms of a mortgage, you would be required to execute. Well, the customer will have to execute a document called a deed of variation. Okay, so that is a deed of variation for those of you who want to take a note of it. Okay, but generally speaking, if an all monies clause is there, and again, like I said, if you're abiding by the same interest rate, the same terms, it's going to expire within the same be paid off in the same time frame. So let's say it was 10 years. So letting them get more money means, so for example, if the mortgage document was for $50,000 and they took it down to $30,000, they can take it back up to $50,000 as long as it's repaid in the same time frame. Okay. Now there are some mortgage documents that don't specify. Okay, and several financial institutions refer to them as banking facilities mortgages. Okay, banking facilities mortgages. And they are the same as all monies mortgages. Okay, or mortgages that have the all monies clause in. Okay, so that's the legal mortgage or first demand legal mortgage. Okay, and that document is stamped and recorded in and is recorded in the registrar office. Okay, in the registry. Then we have a chattel mortgage, which is similar in nature to the legal mortgage, a first demand legal mortgage. But instead of being a mortgage over real estate, this one creates a charge over non-fixed assets that are easily identifiable and can be used to capture primarily consumer durables and even livestock. So like the chattel mortgage will cover vehicles, equipment, furniture, and like I said, apart from the those tangibles, it'll cover, you know, if it's a farmer, it'll cover their livestock. Okay, so that's sheep, goat, pigs, chickens, whatever. Okay. Very seldom in the Bahamas is a chattel mortgage used for livestock, but in some of the other Caribbean, some of the Caribbean countries, I know in Barbados, they did a lot of farming loans or agricultural loans, and so the chattel mortgage was quite common in Barbados. Okay, so that's the first one, promissory note, the mortgage and the chattel mortgage. And now the last two. Pledge or hypothecation or lien or authority to hold. Okay, and different banks have different names for them. I think Scotia Bank, they call it the authority to hold. Okay. Okay. So the pledge or hypothecation or lien authority to hold document is typically used for liquid assets taken as collateral. And it is primarily used to capture credit balances on any bank account. So you're looking at cash, primarily cash. Okay, so that'll be fixed deposits, or some people call them term deposits or certificates of deposit. That is the primary liquid asset that is looked at. However, if the customer has a checking account or they have a savings account, it can be used to capture those balances as well. Okay, so if you have a credit facility, let's say you have an overdraft for a customer, and they have a fixed deposit for $1,200, and you've given them an overdraft facility of $1,200. So they have an overdraft facility of $1,000. So they have an overdraft facility of $1,000. They have a fixed deposit of $1,200. Okay, you will take your pledge or hypothecation or lien or authority to hold over that fixed deposit of $1,200. $1,200. Okay, which is $200 more than the overdraft, because you always want to give yourself a buffer for interest and in case you honor a check. Okay, and the client didn't come in and submit sufficient funds or deposit sufficient funds to take it back to within the $1,000 limit. Okay, so let's say, using that example, someone has an overdraft facility. They already had 1,000 limit, but they present a check for $500. you know that you have at least $1,200 of yours. So you go and you pay you wanted a $500 check. So now it takes the overdraft facility up to $1,500. So they now overdrawn $1,500. Okay, but you've taken a lien over their fixed deposit. Okay, so that's $1,200. But they also have a savings account. Okay, and that savings account may have $700 on it. So if the client, you see it come a point in time when there are no more credits coming to the checking account on which the overdraft is held, right? It may be a sign that it's becoming hardcore. Something may be happening with the person in their business. So what you'll do is you'll take $1,200 from the fixed deposit, and you'll take $300 from their savings account to wipe out the overdraft, which had increased now from 1,000 to 1,500. Okay, so the pledge or hypothecation, the lien, authority to hold, while you may take it over a specific account, it normally captures any other credit balance that the person has with your bank. Okay, any questions on that?
No.
Okay. So the hypothecation or assignment of shares. Okay. So like taking a charged document over cash, we have a hypothecation or a assignment document that specifically would take a charge over shares, okay, or stock or bonds. So the lender could choose to accept shares, preferably on publicly traded stock, but in special cases accept shares on privately held companies. Traditionally, you would obtain the borrower's signature in blank at the back of the share certificate and in blank on a power of attorney form. If you were to look at a share certificate, on the back of each share certificate, there is a transfer form, okay? And that transfer form is executed when the shares are being sold or being transferred to a different owner, okay? And so what used to happen traditionally before the Bahamas Central Securities Depository came on stream was that banks would have the client complete their transfer form on the back, and they would leave the date. They would leave the date out, okay. And if the bank had to sell those shares to recover its debt in part or in whole from the customer, then the date will be inserted that it was sold. And then also there is a power of attorney form, again, that is executed in blank without the date on it, given the bank the right to sell the share certificate, because remember now, the share certificate is in the name of the individual. So the power of attorney confers the right over access to those monies to the bank. Okay, so when the check is issued, the check would be issued to the in the name of the bank and the person who had owned the shares. Okay, it's similar to when you're doing an insurance settlement. The check comes in the name of the bank and the customer. Okay, so it's again, like I said, similar to the bank having an assignment over an insurance policy, a car insurance policy, or a house insurance policy. Okay. But nowadays, share certificates aren't really issued. What they have is they call now book stock. Okay, book stock. So companies now they'll issue the shares, but the evidence of those shares is the record of those shares is held at the Bahamas Central Securities Depository, or BCSD. And so, for example, people who may own Commonwealth Bank shares, or the Arawak Port Development shares, or any other shares that are, Fico shares, or any other shares that are traded on our local stock market, or I should say capital market. It is registered at Bahamas Central Securities Depository, and it says it has the name of the individual or the business that owns those shares, the amount of shares. And if the bank has to take an assignment or hypothecation over those shares, a form letter is executed by the client that is sent into the Bahamas Central Securities Depository, and they would make a record. They would keep a record that XYZ Bank has an assignment over those shares. And if the person comes in and say they want to sell the shares, they would have to produce a release from the bank or financial institution saying that they no longer hold the assignment over those shares. It is a much safer way for banks nowadays, because in the past what used to happen is when we used actual certificates and they were signed in blank by the customer, most financial institutions did not record those in the registry, so there was no record, or they did not send in, they did not notify the particular company, the actual company, that they hold shares, that they're holding XYZ client shares as collateral. So what we found happening was that the owners of the shares would go to those companies. So for example, let's say it was Arawak Port Development, okay? So they would go to Arawak Port Development and they would say, I've lost my certificate. So after a certain period of time, Arawak Port Development will issue a new share certificate to replace the old one. And so then the customer will take that certificate and either pledge it as collateral security to another financial institution, or they will sell the shares. And so when if the bank had to now to realize the shares, they found out that one of two things: either the shares had been sold by the client, and so they no longer exist, or the shares had been assigned to another financial institution. Okay, so you have two financial institutions, vying for now the same shares. Okay, so the fact that it is now going through the Bahamas Central Securities Depository is a better way and a safer way for us as financial institutions. And I think too for the clients, for the customer, it is safe now, because then you don't have to worry about for people who would not pledge their shares to the bank. They would either have to put them in a safe at home, or put them in a safe place at home, or they would have to get a safe deposit box at a financial institution to keep them in. So storage of the certificates proved to be a challenge for clients. So in this way, it is a safety net for both the clients, the owners of the shares, and the financial institutions who are lending against them. Okay? Any questions? Various documents? Okay, let's look at storage. Okay, So you may recall from a previous class that we talked about the credit file and the collateral security file. The credit file is that file that you use every day in your credit department. Some people refer to it as the working file. Okay, so in that file you have, customer correspondence or copies of loan applications or credit applications and stuff like that. So correspondence to and from clients, and it would basically have a copy of the credit that you or the different types of credits if there's more than one. So at your fingertips, because the other file is the collateral security file, right? And those are not something that you would handle every day because they have your loan documents. Oh, excuse me. Okay, because they have your loan documents. So the credit file would contain items that don't need to be stored away and under dual control or under secure and fireproof standards. Okay, the credit file is stored in locked cabinets overnight within the credit department, and in some cases there's actually a book vault where these cabinets are kept. So sometimes the cabinets may be on the outside in the credit file, the credit department area, or they could be in a separate book room or book vault. Okay, but they're easily accessible. Okay, depending on the financial institution, these lock cabinets may be just regular cabinets, or they may even be fireproof cabinets. 1 hour, 2 hour rated. And when I say 1 hour, 2 hour rated, that means that if a fire rages for an hour or 2 hours, the cabinets can withstand heat and fire for up to an hour or 2 hours. Okay, but those kind of filing cabinets are pretty much expensive, so you'll find that financial institutions generally use the regular lock, the ones with the keys. Okay, the 4 and 5 drawer ones. Now, when it comes to the collateral security file, it is a requirement, a mandatory requirement, to store them either in a proper vault or sometimes even in the cash vault. Again, depending on how large the financial institution is. So the cash vault may be large enough to have filing cabinets that can store the documents. And again, these would be that particular vault would not just be secure in terms of the average person being able to break into it, but it also would be fire rated. Okay, and so you'll have a higher fire rating on the cabinets than you would have for the credit files. Okay, and as it says here, this is because security files and the documents therein represent the bank's possible claim against its customers' assets, and at the very minimum, the bank's safekeeping of those assets. Okay, so your mortgage documents, your chattel mortgages, your liens, your hypothecations, those are the type of documents that'll be in the collateral security files. Okay. Any questions on that before we move on to page 55?
No.
Okay, so let's move on to page 55, top of page 55, and talk a little bit about monitoring and controlling reports and some of the okay, so in order to effectively monitor and control accounts, bankers must do several things. Okay, and six of the major items are listed there on page 55, the top of page 55. And the first one is review daily excess reports, periodic reports, periodic arrears reports, margin reports, and I'm going to go through some of those reports momentarily. Okay. Examine frequent encroachments or temporary increases to credit facilities. That would be, for example, encroachments would be, let's say you have an overdraft facility and the person, again, let's use the $1,000 limit, and someone presents a check that takes them over the $1,000 limit. Okay, that would be an encroachment. Or it could be someone who has a current account, a checking account that does not have an overdraft limit, but they are frequently issuing checks and they don't have sufficient funds. So that is also an encroachment. Okay. And also temporary increases to credit facilities. So it may be someone has a $1,000 overdraft facility, and they say, listen, for the next 3 months, I'm going to need a $1,500 limit. Okay, so you'll increase it temporarily to $1,500 for the next 3 or so months, and then it goes back down to the $1,000, and then you look to see how often they're requesting temporary increases to credit facilities. For that type of report, you would, when it comes to the annual review of the overdraft, you may want to recommend to the client that if they anticipate that kind of cycle in the next year, they may just want to simply increase the limit to $1,500. Okay, rather than engaging you for temporary increases. Okay, because every time you do a temporary increase, basically you will charge the client a fee. Okay, so it's causing the client a fee because it's costing you time. Okay, so if you can, if you see that there's a pattern, or you sit down and you talk with the client and find out that if there's a season, so let's say for example, the summer months, they may require the increase either because stock does not turn over as fast during the summer because let's say schools are traditionally closed during the summer. So, and the things that they sell, so for example, if they their little store next, their store in the area where in a area, and they sell school supplies kind of thing, or uniforms. They people are not buying it in the early summer. It's towards the end of the summer when those things are purchased. So for 2 or 3 months, they may need the temporary increase to help them to buy the supplies for the back to school. Okay, so one, they have a decrease in sales, but then they are also anticipating back to school sales. So they need to increase, one, to help them pay ongoing bills, plus to pay for the supplies in preparation for the back to school. So if you see that is a cyclical problem, then you may just tell them, hey, just increase it to $1,500 one time, because it's and just pay that one-time fee because it's cheaper than when you come into us for the temporary increase. We still charge you the $100 or whatever it is, the 1% all over again. Now, in some instances, the bank will only charge on the increased amount. So, they would charge the 1% on the $500 as opposed to the 1% on the $1,500. But you may find that the bank may want to discourage a client from coming back so frequently. So instead of just charging the 1% on the 500 to discourage the client, they'll charge the 1% on the $1,500 because they're saying that they are now renegotiating the overdraft facility. Okay, so you may want to encourage the client to just increase it one time in the next year when it comes up for review, and then that will also free you up to deal with more significant credits. So rather than having to take an hour or two to deal with a $500 increase, you could be using that hour or two in that particular day to deal with a $10,000 credit or $50,000 credit. Okay, so so it's all relative depending on, you know, if you have the time to do it, fine, but if not, try to maximize your time and also maximize the ability to bring greater income to the organization. Plus, you also have your quotas that you must meet. Okay, so if you could spend that 1 or 2 hours bringing in $10,000 or $50,000 as opposed to dealing with $500, you would be viewed in a better light by your supervisor and your managers in any event. So it's a win-win-win situation all around for you and the client and the bank. Okay. The next one is conduct testing of covenants, and so what that entails is just looking at what the different requirements are for that particular facility, and looking to see if that they actually exist. So if the if one of the covenants was to ensure that the property is maintained, or you have sufficient insurance coverage over your stock in trade, you would actually go and physically visit the site to see that that they're maintaining the property at a certain level, or that there's actually stock there, and that you have the current insurance policy in place over that stock for that particular customer. Okay. Another thing you want to do is conduct a comparison of actual to projected financials. This normally happens during review times, and for businesses, again, every credit facility is reviewed each year, even though, like I said before, it may be a mortgage, maybe a 10, 15, 20-year mortgage, but because it's a company, a business, you have to look at the company's financials. So, so you look at the actual performance of that company versus the projections that they provided when they first came for the facility. Identify any deterioration in cash flows, any decrease in the security value, any changes in company management, any negative client publicity, because that will affect your client, and any other material adverse change. Any questions on that? Okay, no questions on that. The next point is related to the conduct testing of covenants. So you want to carry out periodic site visits and spot check inventory. Okay, that's self-explanatory. Then you want to take notice of the passage of any new laws that may affect the industry, that is the industry that that your client is in. Any new entrants, that is anybody else coming in with the same type of business, because that may have an impact. Because as more people get into the market, it means that your client's market share is threatened and could possibly shrink. Okay. You must look at increased marketing strategies from that competition, those new entrants or existing competitors. And again, you need to consider any negative client publicity. Okay, so you have social media there, and people talking bad. Let's say, Glenn's fried chicken, and people talking bad about how the chicken was stale, tasted like it was there from over the weekend. So you would want to say, oh boy, Glenn's fried chicken, that's one of our clients. So you want to take note of that, and if there, other people joining in, yeah, the other day, blah blah blah. So you want to take note of that, and if it persists, you may see some deterioration in either their deposits, which means the business is going down. It has been probably affected by that negative client publicity. So it's necessary again to look at any negative client publicity. All right. So those are several things that you can do. That they're by no means all that you can do, but there's some major things that you can do to effectively monitor and control your client and their accounts with you. Why do we need to monitor and control? Well, I mean, we've discussed some of them here, but let's look at it more specifically. Okay, the ongoing monitoring and controlling of accounts, and this is these are extracted from that middle paragraph on page 55. The ongoing monitoring and controlling of accounts helps to identify, prevent, and minimize potential risk and losses that might occur due to a material adverse change in the affairs of the borrower. And like we were saying earlier, the last point in particular, any new laws that may affect that particular industry, new people entering the same market, increased competition strategies from existing people in the industry, competitors, any negative client publicity. Okay, so those are material adverse changes in the affairs of the borrower. Right. The second is effective monitoring and controlling of accounts serve to improve the quality of the loan portfolio, that is the asset quality, and provide training when necessary. So, so someone who is lending, they may have to go to site visit. They may be sent on their own, or they may go with a more seasoned lender, okay? Or in reviewing the customer's financials, you may sit with a more seasoned lender who knows about reviewing a business's financial statements. And so in that way, it provides training to lenders, okay? And then reports and annual credit reviews also helps to identify whether companies are performing financially well, and where applicable, identify additional sales potential for the bank. Okay, so for example, when you're looking at the company's financials, you may find, for example, that let's say they have an overdraft facility. You may find an overdraft facility isn't sufficient, right? And it needs to be increased. So you say, hey, that $10,000 facility you have, you need to increase it to $12,000. That's one way of identifying additional sales potential for the bank, because you make fees and interest income of that increased $1,000 limit. Or you may find that the company, after reviewing, you may say, hey, you have, you're doing quite well. Why don't you consider expanding your inventory space, or opening up another store elsewhere? And so the customer may need financing for that. Okay, so again, that's an opportunity to lend the client some more money. So you're identifying additional sales potential for the bank, and in doing so, you're helping yourself to meet your quota. So if you have so many dollar value in loans, overdrafts, or credit cards, whatever it is, this is one way of doing that with your existing customer. Okay. So any questions on those reasons before we look at looking at the different types of reports that I alluded to earlier when I said we look at the different types of reports later? Any questions?
No.
So look at some of these reports. One of the first ones, well, the first one here listed here is the daily access report. Okay, and you see that at the bottom of your the third section of page 55. Daily access reports. So, for example, exception reports, where they have frequent encroachments or temporary increases. We talked about those, for example, with the overdraft facilities, or checking accounts where a facility in place, but the customers present a check with their insufficient funds. So that would be captured on your exception report. Also, suspense accounts reports. For example, adjustment suspense, and so there may be some items that you cannot apply, and so you may put them to a suspense account. Normally, you have to clear out a suspense account within 24 hours. Okay, one such suspense account is the adjustment suspense account. So if the difference is something, you may put it in adjustment suspense until you, or until the person who is responsible has the opportunity to get back to you, and hopefully it's within the next day, so you can take it out of the adjustment suspense account. Okay, so that's daily access reports, some exception reports. Okay, then there are margins reports. These relate to interest rates, and these are your interest rate reports, because you want to ensure that the correct interest rate is being charged. So on this interest rate report or margins report, you will have the interest rates. So it'll say for your overdraft accounts, it'll say for your consumer loans, it'll have for your mortgages, and in each one of those categories, it'll be further broken down. So for the overdrafts, you'll have whether it's overdrafts to individuals, because that attracts one rate. They'll have one for businesses, because that attracts another rate. And then be those that say secured by cash, okay, which tend to have lower interest rates. So right off the top, you have three different types of interest rates for your overdrafts. So you have individuals, you have your businesses, and each one of those you have your cash secured, okay, because they attract different interest rates. Similar thing with your consumer loans. So those for cars or consolidations, or for furniture, or education, or medical. They all have different types of rates usually, okay, and or they're at least separated in this report, even if they have the same rate, they're separated because for the different types of loans, you would want to charge a different type of rate, okay, interest rate. So if, for example, on a car loan, you see the car loan interest rate at 2%, then you know that something is wrong, because that should be unless it was, and even if it was one of those special rates, when you had like the car show, it shouldn't still be as low as 2%. It'd probably be like 5-7%. Okay, so you notice something is wrong. All right, and also new cars versus old cars. So if you see the interest rate on a used car is lower than it ought to be, and it looks like it's the rate for a new car, then it could be that the loan was programmed incorrectly, and instead of keying in the code for used car at the inputs at the input stage, it was inputted as new car, even though it was a used car. Okay, so then you'd have to go to your loans administration department or whoever is in charge of the inputting, and tell them, hey, you got to correct the coding for that particular account. It's not. It's a used car loan, but you have the base rate pegged to the new car, which is much lower. Okay, so that's your interest rate reports, or your margins reports. Okay, then this is an important one: your periodic arrears reports. Those of you in collections department or asset recovery or whatever fancy title that you give to your collections department nowadays. So these arrears reports will cover your delinquency and non-performing accounts. Okay, so non-performing accounts would be those accounts that are 90 days and over. And you see there it says delinquency starts from 1 day, so it'll show 1 day up to 29 days. Then you get your 30 days, 60 days, 90 days late reports. Okay, so and that is done because of at certain points in time you have to do reports in central bank, and also for your own good, you would want to see how many accounts are 30 days, how many are 60 days, and how many are 90 days, or even over 90 days plus. Okay. Then there are collateral security, compliance, or monitoring reports, and that is your covenants, and also collateral security, out of order or expired items. So you would on the covenant side, you would look to see. So for example, let's say there's a mortgage. And one of the items for the mortgage might be one of the items for the mortgage might be that you need to have the original mortgage document. Okay, and as you may know that you don't get that up front. You don't get the recorded mortgage document up front, because when the customer signs the mortgage document, it has to go. The treasury gets stamped. Then it goes to the registry of records to be recorded. When it's presented for recording, you're given a receipt saying that it's been lodged for recording, and then you have to follow up. 1 month, 2 months, 3 months sometimes. It used to take up to a year. I don't know what the time frame is now, but you have to follow up with the attorney or with the registrar, the registry of records itself, for the receipt of the original registered document. Okay, so that is one of your covenants. Then it's the collateral security, out of order or expired items. that would let you know that. So, for example, let's say there's a insurance policy over a house, and it's getting ready to expire next month. That'll flag on this report, and it'll say so any insurance policies that are due for the next month or two will appear up on this report, and it'll alert you that you need to get the updated or the renewed certificate of insurance before the expiration date, or it'll show that the item has already expired. Okay, so if no action is taken, you would have to to vigorously go after and get the new renewed insurance certificate. Okay, now sometimes it may appear on the expired as expired, but it's just that the loans administration department may not have, or whoever the inputting person is, may not have entered it on the system yet. So you may physically have it, but it's just not appearing on the report. So the report also serves to let you know, okay, you have it, you gotta show it as current. Okay, so if so this is like where the underwriting team would come into play. When they look at this report, they'll say, hey, you know, that you have a number of expired insurance policies there. Okay, and so it might signal to management that the loans administration department may be understaffed and overworked. So you may have to look at probably putting an additional person there to help them to get to input those items, even if it's just a temporary fix. Okay, so it may be temporary or it might be permanent. So these reports can also help from a human resource management point of view, not just from monitoring and controlling on the collateral security compliance side, but they can be they may indicate something else that can help the organization in terms of human resource management and planning. Okay, so continuing with the reports. Here you have monitoring and reporting compliance and non-compliance. These may include your risk rating reports, such as your client's accounts, and they include both deposit and credit accounts. Your politically exposed persons, your PEPs, PEPs, politically exposed persons, etc. Okay, risk rating reports on the deposit. So, for example, a client, when they open the account, they show that they would be depositing, around about $5,000 per month, up to about $5,000 a month. But now you see where deposits coming in, 15 or 20,000. So it'll alert you on the deposit side that for KYC non-compliance issues, you need to look again at that. It could signal that you need to take a second look at the client because the activity is increased, or it could signal that something fishy is happening with the client's account. So it could be one way or the other. It could be a negative indication, as well as it could be a positive indication. On the credit side, you're risking your rate risking the account. You're risk rating the account, and we're going to look at that risk rating probably not this week, but next week. We may get to look at risk rating. Okay, so you're looking at is it a high risk client, a low risk client, a medium risk client? Okay, so and the same thing with PEPs. PEPs are normally listed as high risk because people who are involved in government, MPs, cabinet ministers, permanent secretaries, senators, senior people in government, like directors of departments and corporations, they are always targets for people who want to do fishy business. Okay, so politically exposed persons would be rated a high risk. Okay. Then you have your annual credit review reports. You recall that I said all overdrafts and commercial loans are commercial loans, again, whether they are they can be for 3 years, 5 years, 10 years, 20 years. They have to be reviewed annually because of the nature. You have to look at the customer's financial statements to make sure that they are a going concern. Okay, overdrafts are reviewed annually. Okay, they're for 12 months. Then, of course, politically exposed persons, they undergo a annual review, whether they have credit facilities or not. Okay, so you would normally you would send out you would send out some indication, some form document to politically exposed persons, some kind of questionnaire, whatever it is. They would complete it and return it to you. Okay, so that's your annual credit review report. Then there's portfolio size stratification report. And what that does is that it lists all your accounts by balance or exposure size. Okay, so it'll show you accounts that are, when it's 10,000, 50,000, 100,000, $500,000, $1 million, So it lists the portfolio by the size of the credit. Okay, so that's portfolio size stratification report. And then, of course, this goes hand in hand with your delinquency that we looked on the previous page. Your delinquency reports, early warning signals. Again, daily excess reports, you want to use those. You want to use your periodic arrears reports to tell you, give you an idea what's happening with your customers. Okay, and then finally, you have managing arrears reports, and these would document calls to customers, any system-generated past due notices, formal letters, letters of demand, any collection activities, repossession and foreclosure activities, and again, with respect to delinquency, non-performing, problem loans, and watch list accounts. Okay, so delinquency, again, any account from 1 to 89 days, non-performing accounts are 90 days and over. Problem loans could be your non-performing loans, or those loans that you have problems with every month. So every month they have delinquency. So they're problem loans identified as problem loans, and certainly they would be on your watch list accounts. Okay, so the watch list accounts includes not just your loan accounts, but includes your checking accounts. Okay, those accounts where there is an overdraft facility set up, and even those that don't have formal overdraft facilities. Okay, those are your watch list accounts. Okay, And included in that watchlist accounts could also be a PEPs, for instance. Okay. Okay. On that, on those reports,
No.
No, sir.
no questions. Okay. All right. So in this chapter, we've looked at the various documents used: the promissory note, the debenture, the legal mortgage, the chattel mortgage, the pledge or hypothecation used for cash, hypothecation document or the assignment for shares or stocks or bonds. So those are the various documents used. We looked at storage, management and control of credit files and security files. And then lastly, we looked at reports. Okay. Looking at chapter 10, in the time that we have remaining. Okay. So let me just take a quick look at review questions for chapter 9. Question 1, promissory note, chattel mortgage, debenture, loan application. Right, okay, yeah. So I tend to do, you know, the review questions on page 44. Alrighty. And to assist you with that, like I said, I will be giving you a homework assignment tonight. All right. So let's look at page 58. Let's look at credit risk rating and report agencies. Okay. We're not going to spend a lot of time on this. We're going to hit some of the key points. Okay. So you've heard about credit scoring and credit ratings. The three top credit scoring and credit rating agencies are Equifax, TransUnion, and Experian. Okay. And the US model, we're going to look first at the US model. Okay. And they use Equifax, TransUnion, and Experian. Okay. Some other countries also use one or more of these credit scoring agencies. Okay. It says your credit score determines what type of loan you qualify for, or if you qualify at all. It determines your interest rate, which determines your monthly payment, among other things. Now, I'm doing this particular chapter because of the introduction of by the central bank of the credit rating, credit reporting. Okay, so we're gonna look at the basis for credit reporting or credit rating. Okay. So again, your credit score determines what type of loan you qualify for, or if you qualify at all. Secondly, it says your credit score is also known as your Fico score in America. No doubt we will eventually have something similar in ours here in the Bahamas. Okay. And they call it the Fico score because it's an acronym for the Fair Isaacs Corporation, who was the creator of the software used to calculate credit scores. Now, whether we're going to use something similar here in the Bahamas, quite possibly we will. But we will see in a minute categories. Actually, in the next slide, we'll be looking at what is all in a credit report. Okay, so so that those first two things, your credit score determines what type of loan you qualify for, or if you qualify for it at all. It determines your interest rate and determines your monthly payment, among other things. Like on TV, you see these people talking about their credit scores that are going up, and some of them like 600 and something or whatever it is. Well, that's what they're talking about. Okay, then secondly, your credit score is also known as your Fico score, and thirdly, the scores range between 350, meaning that you're extremely high risk, and 850, extremely low risk. Okay, so the lower your credit score, the more risky you are as a risk to the lender. Okay, so a customer with a score of 700 some and above would be someone who you would want to lend to. Okay, so let's look at what is in these credit scores. What makes up these credit scores? So first of all, let's and this is on page 61. Okay, so on page 58 and on page 59, you don't need to be concerned about that. Okay. Okay. So let's go straight to page 61. What's in the credit scores? So we have the first one is payment history, and that makes up 35% of the overall score, and that would include things such as bankruptcies, late payments, past due amounts, and wage attachments. Okay, and our local credit bureau, that's the word I'm looking for, the credit bureau, our local credit bureau, that's what they are focusing on now. Okay, accumulating information relating to bankruptcies, late payments, past due amounts. Okay, and possibly wage attachments will be an arm, if not now, probably in the future. The second item that I looked at is amounts owed by the client. That contributes to 30% of that credit score. So any amounts owed on accounts or the proportion of balances to total credits. Okay, that will probably come later on in our own credit bureau, but certainly payment history is definitely a part of our formation, the early stages of our credit bureau. Okay, length of history will probably also be factored in our credit bureau, and that would be captured in probably the payment history. So, but in the overall in the U.S. and also Canada, the UK, they basically follow this format. Okay, so payment history, amounts owed, and now this one, the length of credit history, the time since accounts were opened, the time since the last account activity, that accounts for 15% of the total credit score. Then any new credit, whether the credit is actually approved or whether you made inquiries. So in the US, you will hear people saying, you have to be careful when you are even inquiring about, borrowing. So people who are looking for a car, they're very reluctant to give their name to the car salesman, because the car salesman immediately goes to the credit rating agency and puts their name in. So even if you don't buy the car, that goes against the client. Okay, so inquiries will also contribute negatively to your credit score, to the overall credit score. So it's 10% of that. And then finally, the types of credit, that contributes 10%. So depending on whether it's a credit card, it's a consumer loan or a mortgage, the credit type also factors in your overall report. Okay, so that's what makes up the credit score: payment history, amounts owed, length of credit history, any new credit, whether it's actually approved or just an inquiry, and then the types of credit. Okay, so most countries like the United States and Canada, they use a scale of 0 to 9. Okay, to reach personal credit. On that scale, each number is preceded by one of two letters, either an I, indicating that it's an installment loan or installment credit, or an R, indicating that it's a revolving credit, like a credit card or credit line, okay, overdraft. So the scale rates from 1 to 9. I'm sorry, 0 to 9. 9 being the most risky, and preceding each one of those numbers would be the letter I or R, and I'll look at the actual consolidated. We'll consolidate that on the top of page 62 in a minute. Okay, and then thirdly, it says here that we ought to go to the next slide. Okay, so here you have it, the rating and the description, 0 to 9, so 0, 1, 2, 3, 4, 5, and I have it color coded. So so R, remember now, R is revolving credit. I is installment. Okay, so it'll indicate whether it's revolving or it's an installment loan. I mean rating. So 0 means that you're new to the credit world and you have an insufficient credit history for making an accurate judgment of your future risk. So that's 0. Okay. 1 and 2 are low risk. That's why they're in green. Okay. You pay your credit back in 1 month. 2, you pay your credit back in 2 months. 3 is starting to get a little concerned. So that's amber or warning. You pay back in 3 months. 4 is a little bit more of a warning. You pay it back in 4 months. 5, red alert. You have not repaid in 4 months, but you're not a 9 yet. What happened to 6? Okay. 5 and 6 and 7, 5, 6, and 7, they're kind of within in that same range. 7, your debt payments are not made under consolidation. Sorry, are made. Your debt payments are made under consolidation. Okay, so it means that the client has consolidated. 8, the debt was cleared by selling the item, that is repossession. And then 9, you officially have bad debt, you're in default, which means it is usually uncollectible. Okay, so we said that the rating is anywhere from 0 to 9. It would either be identified as installment for I or R for a revolving credit. Okay, now when we look at Basel, this is where it starts to get a little complicated. Basel has a rating terminology, or Basel, some people will say, and they have 4 terms they use when defining credit risk. So there's a probability of default, that is the likelihood of a default, expressed as a percentage. It is a loss given default, or LGD, which is the magnitude of the loss expressed as a percent. And then you have your exposure at default, EAD, what is the expected loss, and that is the bank's exposure in dollar terms. And then, of course, you have maturity, which we all prefer, which is M. So you have PD, LGD, EAD, or EL, and you have, fourthly, maturity. Okay. So I'm going to come back to that in a minute, but let's look at asset classification and credit risk ratings. Okay. Remember back here, we started by saying 0, they didn't have sufficient. Then we moved to green, then to orange, then to red, then to blood red. Okay. So keeping your eye on that, and then looking further down on the page, you'll see this here. Minimal risk 1, low risk 2, moderate risk 3, acceptable risk 5, acceptable risk 4, special mention 5, substandard risk 6, doubtful 7, 8 is loss. And then, of course, when we know 9, we said it was uncollectible. Okay, so so in terms of asset classification, I've color coded it. So when we look at the next slide, put everything together, put the US model together. We put Basel ratings together, and we put these other classifications all in one page. And that's where we come up with this. Okay, so that's giving you a complete picture. Okay, so we put everything together. Basel says with a minimal risk, low risk, moderate risk, acceptable risk, special mention, substandard, doubtful, loss. And then you have the risk rating is 1, 2, 3, 4, 5, 6, 7, 8. And then you have the next column. Where you have your ratings of 0 to 9, and indicated whether it's an installment or it's a revolving credit, and then what all that means. Okay, so for 0, again, you are new to the credit world, and then you see 6 is there, and that's why I said previously that 5 and 6 are kind of like in a similar, because you're going into the amber, into that warning before you get into that red zone, and then the blood red zone. Okay. Any questions on that, folks?
No.
All right. So the homework that I give you will give the types of questions that'll be asked. Okay. Some of them on the chapter. Okay. I won't get into the central bank, but you can. The central bank has some articles, and it also has some some PowerPoint presentations. There were at least 2. There may have been more now. Where they talked about the credit bureau, the Bahamas Credit Bureau, what it is, what it most likely will contain. Okay, there won't be any questions on the content of that, only to the extent that credit bureau pretty much mirrors, the established credit bureaus. So the questions, the type of questions you should expect are like those on the review questions on page 64. Okay. So we don't get into that chapter too deeply. Okay. Are there any questions on this one? If not, that is for the night. Again, read chapter 11 and 18, chapters 11 and 18. And in particular, chapter 18, look at chapter 18. Just in the event that we don't do chapter 11, because next class I want to go over the Browns, the one that we did, was that James and Paula Brown? The case study type question. I want to go over that because they're particularly the three major assessment factors, for credit Cs as well as Campari next week. So that may take up the time that I want to use on chapter 11. So if we don't have sufficient time to do chapters 11 and 18, we would definitely do chapter 18. So make sure chapter 11 you could read that in the event that we do, but definitely chapter 18. Look at that, please. Okay, and I will be sending a homework assignment. You should get that by in the morning, the latest. Okay. And please collect your scripts from the Institute. Okay. And that's it. All right.
Alrighty.
Aye.
You all have a good night.
Good
Have a good
night.
weekend.